Thanks for stopping by. Today I want to run through provisional tax because it's a topic that confuses a lot of business owners and has a really big impact on people's cash flow, so it's important to pay the right amount of provisional tax at the right time so that you don't get any nasty surprises along the way. My name's Hamish and I'm the Director here at IIF Chartered Accountants. We work with small and medium-sized businesses to make sure they pay the right amount of prov tax at the right time so that their working capital and cash flow in their business is as smooth as possible. So as I said, today I want to run you through provisional tax and what it means to get it right and wrong. So let's say, for example, that for the 2017 financial year your income was 120. Okay. So if your income's 120, the tax that you're going to pay each year is roughly $30,000, give or take. What provisional tax says is that for the 2018 financial year, the IRD expects you to make a tax payment equal to what you had the year before. So 30k plus 5%. So you're going to end up paying around $32,000 in tax, which if you end up earning a similar amount to the year before, it's fine, because come the end of the year you've paid the right amount at the right time. But if your income's gone up or down, then the provisional tax that you've paid based on the year prior with 5% won't be the right amount. So that can often come as a shock or a surprise to some people, which then they've got to find a way to manage their way through. So in this example, people set their 2017 accounts in March. They're then required to pay provisional tax in August, in January, and again in May. At each payment they'll be paying roughly $10,000, which is all well and good if your income doesn't change, but then come March 2018, at that point there, when your financial statements and tax returns are done, there's a wash-up calculation which comes through. So it might turn out that once that wash-up calculation is done, your income for the 2018 year was, let's say, 180. So there's a decent jump up in profit there, which is awesome, but correspondingly your tax bill increases the same. So tax on 180 is going to be roughly $50,000. You've already paid 30k in prov tax along the way, so they're the payments back in August, January and May each financial year, which leaves you with a bill to pay to the IRD of $20,000. Now, all well and good that you've earned more along the way, but if you're anything like most business owners, you don't have 20 grand sitting in a bank account. You've reinvested it into plant and equipment, into inventory, into the raft of different things that you need to spend in your business. So that then can come as a massive shock and be really difficult to fund your way through. Conversely, if your 180k wasn't 180k and you had actually earned 80 for the year, your tax bill is then, it's going to be 18 to 20. You've already paid 30k in prov tax, so you end up getting a refund from the IRD of 12 grand. Now, great to have a refund of 12 grand from the IRD, but it meant that you paid too much along the way. So you've funded that through your business and you've taken less drawings from the business during the year because you've wanted to be paying your prov tax on time, but it comes at a cost, which is tighter working capital. So this is well and good to say because in theory we can all estimate what our prov tax is and get it right, but it's easier said than done. So I guess the call to action today would be to go away, and if you're using software like Xero, you can pull a profit and loss report for your business very accurately and in real time. You can then compare your profit and loss to date back against what you've actually paid in prov tax and hopefully get a handle on whether you've paid enough or not quite enough along the way. You can then adjust your payments up and down, or even look to get some tax finance to fund your provisional tax, which I'll cover off in a separate video. All of that can help smooth your working capital and make sure that you've got enough tax put to one side. The outcome is no surprises and the right amount of tax paid at the right time, which means you've got the right amount of working capital invested in your business, and your cash flow cycle would be smoother. if that's a little tricky to work out, feel free to get in touch with us, and we're happy to have a no obligation chat to you about putting together management reports for your business. What the management reports help you do are to identify your profit and your loss in real time throughout the financial year, so you can respond to increases or decreases in your profit, increases in margin or drops in productivity, and then hopefully earn more along the way. Alternatively, check out our ebook on cash flow management. You can find a link to that below this video, and it's got some really great tips for you on how to manage your cash flow on a day-to-day basis so that you're better placed to make the right level of tax payments when they fall due. Thanks for watching.